With that, I'm going to introduce Bruce Norris. He's been in real estate investing for over 30 years as hard money lender, real estate investor, and builder. Welcome to the stage, Dad.
Thank you. Good morning. Thank you so much for coming. This is an exciting day. I learn something every time we have this event, and it's because I have an expertise in one chunk of this industry, and then I need help in all the other ones. And so the team that you'll be hearing from are people that we have learned to trust and listen to. So it's always been a good day for me to attend. One year it saved me tons of money because I didn't know a certain rule existed. And so when I heard it, we still had time to take advantage of it. So that was exciting. How many of you are hearing the Norris Group speak for the first time or first time at an event? Okay, quite a few of you. What we do as a company is numerous things. It started with me buying and selling houses. So you've seen those TV shows about flipping houses. That's something I've done since about 1980, 81. It kind of grew into an education business because we were good at it. Somebody said, "Would you teach me how to do it?" And so we decided that we would make that part of our business. And for many years, we've taught other investors how to do what we did. And then some of them became successful, and they said, "Can we borrow money?" And so we started a hard money loan business. And so now we've lent, I don't know, my goodness, hundreds and hundreds of millions of dollars to investors on deals that they find. And so that's the full circle of the business that we've done. We ended up with a radio show. We have interviewed many of the people that have lobbied Congress for our industry. Presidents of Mortgage Bankers Association. We had one recently where he was in front of Congress 16 times in 2008 and 9 when all the bad stuff was going on. So it's a free asset. You can go to our website, thenorrisgroup.com, listen to any of the radio shows that we've done over the last 5 or 6 years. We try to interview people with you in mind, saying, if you had an audience with this person, what would you ask? And so that's what we try to ask. With taking this house and turning it into that house. That's what investors do. I've really long believed that we've kind of gotten a bad rap. A lot of cities say, okay, an investor owns too high of a percentage homes. That means the neighborhood's going down. Well, that's what we bought, and that's what we turned it into. So did we do something good for the neighborhood? Investors really do a lot of good. We end up taking probably the worst house in a neighborhood, and if we sell it, we end up with the highest comp for someone else in the neighborhood to bounce their sale price off of or their refi off of, and instead of living next door to that, you're next door to that. So I've always felt that we bring something to the table when we buy a property, and I've always been proud to be an investor, and I think one of the things that we've been able to do is get other people to think that way as well. Realtors, years ago, were very difficult to deal with. They always thought investors were like the bad seed. And we've won them over now. And so we speak in front of the realtors all the time. So they understand what we bring to the table much more than they used to. Over the last few years, we've had these amazing interest rates, and it's done a couple of things. One thing, it's made it very easy to buy a home, but it's also made it very difficult if you have money to get a yield. And so a lot of us have had to figure out other ways to invest money, things that we didn't know before. The other thing it's done, and this is an affordability chart that's from California Association of Realtors, and usually it's reflecting the affordability for an owner-occupant, but what these low interest rates have done also is make rentals cash flow. California usually didn't enjoy that. Usually you bought a California rental and had a negative cash flow, but it had an upside for price, and that's why you bought it. And this last time, it's been very different, so we've had participation from groups that we've not had before. Because things cash flowed, you had hedge funds very interested in buying lots of real estate, and you had investors buy more than they normally would. Inventory has been very tight, and so prices have risen over the last few years. The current investor financing is a little bit of a problem. One of the things that we were allowed to do is we were invited back to Washington, D.C. by Fannie Mae to speak with Fannie Mae and FHA in a meeting one day, trying to get them to loosen up the financing for investors. Apparently, we did absolutely no good because they changed none of their policies, and you can still get a maximum of 10 loans if you're an investor. And so what that necessitates is it necessitates financing other ways. And that's where private money comes in. Private money is really taken over the financing for investors by necessity because there just isn't standard financing for a lot of the investors that do volume. Other investment choices. I don't know about you, but I like to invest something that I feel somewhat in control of and that actually produces a yield. So I could buy a 10-year T-bill, and I think it's all the way up to 2.25 right now, but that doesn't excite me too much, and I'm sort of stuck with that for a long time. The stock market, I was very involved in the stock market for about a 4-month period in my life, and it was a very interesting time. I invested $260,000 at the almost very peak of the market in I think it was 1999, and it went up to $850,000 in about 50 days, and I thought I was a genius, and then it went down to $100,000 before I sold it. And I realized that I don't have a clue what I'm doing, and I was also very uncomfortable with that investment because I could see it every day. I don't know if you like that or not, but I don't. If I have a rental home or if I have a trust deed, I don't have to go to the house. I don't see a ticker tape going, okay, well, your house has gone up or down, and it kind of drives me nuts. And so I realized for me, there was a certain investment type that I should be attached to, and it's mostly connected to the real estate world. Why trust deeds? For me, I like monthly cash flow, and we've surveyed people that have trust deed investments, and that's one of the things that they want is they want to get a monthly check. So all of our trust deeds that we'll be talking about has a monthly payment. Some of our competitors don't do that. They do straight notes. And what we have found is that we want somebody to know that they have a monthly payment attached to what they've just borrowed. Or things that get out of hand. You could borrow a lot of money, and 6 months later when you're supposed to get paid back, they're upside down, and you don't know it until it's a little bit late. So all of our trust deeds have monthly payments. The security for the trust deeds is on a first trust deed, and we're one of the few companies that don't pool money. So one of the big advantages of any of our trust deeds is you'll be the only one that's on it. So in the rare case something goes wrong, you'll only have to look at yourself in the mirror and say, what should I do? If you're a part of a pool, what happens is, first of all, the decisions usually are not yours anymore. You invest in a pool, and at the end of the month, you get told, well, we invested $200,000 for the pool, and you really didn't have any checks and balances. You didn't get to go look at the asset. You didn't get to say, you know what, I'm really uncomfortable with that 500-acre parcel in Phelan or whatever it is. You know, you could say, you know, I'd rather invest in a certain type of product. So we don't pool people's money together. And so it's always one person, one trust deed. Unless you ask for, let's say you have a mother and a son, you want to join something together, that's a different story. But by and large, everything is one person, one trust deed. Diversification. I own rental property, and I have trust deeds. Which of those do you think is more hassle? It's the rental property. There was a storm last year in Riverside, and it took out about 100 foot of fencing on a rental that I had. And I got a phone call, and I had to fix it. And if I had a trust deed on that property, what would have happened? Nothing. I wouldn't have got a phone call. I would have got a monthly payment. I might have heard the story, but I probably wouldn't have even heard the story. I just get a monthly payment. So I like that diversity. There's a part of me that really likes the calmness of trust deeds. At the Norris Group, we're interested in knowing when to do things. And so we do research all the time on the market. And it's important when you're investing. We have something like $60 million of other people's money involved in trust deeds right now. It's important to have an idea of when you're supposed to pull back from being aggressive. And so we look at charts to tell us that, and we would make decisions to where our investors won't have those problems. Simplicity of a trust deed. This is the nicest thing. First of all, you understand the concept. how many of us have not borrowed money ever on a piece of real estate? I mean, that's the nice part is we all understand what a first trust deed is. We may not be used to being on the other side of the table where we get the check, but it's that simple. So just like when you borrowed money from B of A and you made a monthly paycheck or monthly payment to them, that's all you're getting. You're getting a check from somebody that borrowed money, and you kind of get the concept. It's easy. When you go to make an investment, if you can choose to go see the asset, you can stand in front of it. You say, okay, well, this is worth $120,000, and somebody's asking me to put up a loan of $70,000. Will that be okay? And that's a nice thing. You can go see the asset. There's times you might see the asset and say, that's not for me. By the way, we do that a lot. Most of the time, you don't realize how much we say no. Norris Group says no to a lot of things, and for a lot of reasons. You could have the perfect house, but you could have the wrong borrower. You could have a perfect project, but have a buyer that's incapable of fixing that particular house. So we're very good at saying, you know what, you found a good deal. Problem is you don't know how to fix the foundation. This is your first house. That's a bad loan. And so we don't put people in positions where we know they're going to have a chance to have a problem. We like a very boring loan business, to be honest with you. And I'm sure for most people that invest in trust deeds, that's the last thing you want is you don't want to go after the asset. You just want to get a check. That's it. And so that's what we try to do. You can know the borrower has skin in the game. So when somebody borrows money from us, unlike what they've heard at seminars, if you go to a seminar on any given weekend, you'll hear that, oh, hard money loans, yeah, you can get no credit, no money down, everything. And then the reality is we have people come into our office, and that's what they say, you know, we're ready to borrow money. And then they find out that they have to have 20% into the deal or something. They're just like, what? And one of them I sat down with because he was pretty upset because he was promised something after paying $25,000 for an education. So, you know, expected that he was going to come in and get millions of dollars of money without having a dime. I said, man, that's just not how it works. Think about the other side. You know, why would somebody do that? Why would somebody put up their hard-earned money? By the way, that's how I finally figured out why there's a nomenclature for our industry called hard money. And I've always thought of trying to figure a better way to say that because it just seems so unattractive. But I realized finally what it meant is that it's so hard to accumulate the money over a lifetime to be an investor in trust deeds. That's what's hard about it. And then when borrowers borrow the money, I want them to respect how hard it was for somebody to accumulate that and respect it and make the payment. So I like the name now. I figured out how to make sense of it. Also, the borrower that we have is a repetitive client with a profit motive. So hard money has a choice. It can loan to somebody that's got a problem. And we call those situations. So you can have a situation come up. I'll give you just a quick example. Somebody has a house that's $200,000 value, free and clear. They don't have a job. They have a 300 FICO score, and they want to borrow $120,000 against it because they have $120,000 of problems to solve. So the day you fund that loan, what's the likelihood of you getting the first payment? It's diminished because all you've done is solve somebody else's big problem, and now they have an additional payment and more problems. And we just don't do that loan. It may sound safe, but it's not the loan that we'll ever do. We don't do situational loans because they become problems. Worst case scenario is if you have a trust deed, you foreclose on a property. We'll talk about in a second the odds of that, but it's very, very rare. And the cost of doing a trustee sale is kind of like an escrow cost. So it's not overwhelming. Trustee sale results, we buy at trustee sales. The average purchase at a trustee sale is somewhere around 88% of value. And your loan to value is never going to start out exceeding 70. The odds of you getting beyond the trustee sale process are very rare because somebody would just buy it. So, and again, we're talking about something that's a very rare occurrence. Worst case scenario is you end up with a rental. And most of us, if we look at, and we'll take a look at the end of the day, or at the end of my session, the cash flow that a rental brings in compared to the payment that you're getting, and you would go, okay, well, I'm going to get more money taking over the rental than I am in my trust deed. It's not an occurrence that we have very often at all. Actually, there's the chart. We have a long-term investment program, and it pays 6.9%, and the ratio of success as far as the foreclosure is 99.4% success rate. I brought a chart like this to Fannie Mae when we were in front of them in Washington, D.C., and I showed them a very similar chart, and they were blown away because we were, lending money at the time when properties were being flipped at something like between 10 or 12%, and we had almost a perfect track record, and they didn't have such a perfect track record. We have very capable borrowers who are used to making their payments on time. 3 defaults, 0 REOs, so all of those loans got successfully paid off before the foreclosure process. That's what generally occurs. This is an example property. We have a Redlands property, $280,000 of value. The loan amount was $195 at 69.64%. Payment to the investor was $975 a month. The investor's collecting $1,450. We do that for 3 years. Typically, these properties that we are doing this particular loan program on, where it has an interest rate of 6.9%, are occupied, already repaired, and in really good condition. And the reason I know that is we say no to a lot of ones that are not. So we're not trying to get the oddball property shoved into this program. We're getting really clean inventory for this particular loan program. San Bernardino, $170,000 house, 110 loan amount, 64.7%. Payment to investor, $550. Doesn't have the rent there, but probably over $1,000 for that particular property. Riverside, $250 value, $174 loan, about 70% LTV. And that property in Riverside probably rents for in the ballpark of $1,500, and the payment is $870. So you can see that every time we're doing a loan, there's a spread. And that's why the investor is doing it. They want the cash flow, and they also want the upside. And when we're doing it at 69% of value, you have room for anything to occur. Your reaction time, you'd be fine. Buena Park, $480,000 house value, $335 loan. So you're protected with $145,000 of equity. Payment to the investor, $1,675. So we do this over counties from San Diego to L.A., but again, we're trying to pick properties that are very safe in this particular program. Who uses hard money loans that have rentals? That's become a very big part of our business over the last few years. We were the first company that came up with a rental program. After I went back to Washington, D.C. and had that conversation with Fannie Mae, I realized they have no interest in being aggressive. And so we created a 5-year program at that point. So we have a combination, and a lot of times when people buy something at a discount, any of those choices make sense. So a lot of times they don't even know exactly what they're going to do with the property yet. So after they close the purchase, they're going, okay, well, maybe this makes more sense to hold or makes more sense to flip. They make that decision, but because they bought it at a discount, that's what's going on in this business, is that we buy things at a discount, usually at least a 20 to a 30% discount, and that makes all this stuff possible. So you have flippers, and builders. So we have people that use hard money loans to build properties from scratch. We've been involved in a couple of those homes recently in Riverside. So it's harder to find inventory, but you have a very high desirability of something that's affordable and new. So we did 2 homes last year. We made $100,000 a piece on each of those, and we could have easily afforded to do it with a hard money loan. So that's also part of what borrows money. The lender that we don't deal with is an owner-occupant. So none of our loans will ever be lent to somebody that lives in the house. And that may sound strange to you guys because you think, well, okay, that's got to be the safest loan. And it's the most unsafe loan there is. Because once again, you're solving somebody's problem. If they're coming to us borrowing at hard money rates, that means they've been told no by everybody else in the world, and they're solving a problem that your money goes to solve, but the next day they have additional problems called your payment. That's not a loan you want. And it's interesting to talk I listen to Craig talk on the phone all the time, and he's like a detective. And it's funny because people think that's probably what we want to hear. He'll ask, okay, are you going to live in the property? And somebody will say, yeah. And you go, okay, well, that's not a loan that we do. Thanks for calling. It's like, wait a minute. I was just kidding. And see, you can't recover. And then we've actually had people call under like a pseudo name, seeing if they could get the loan some other way, because it's just, they find out that the world is tightened up for people that have problems and own a home. It's really hard to access loans if you have equity, but the odds are you're going to have a problem making the payment. That loan just starts not to be available. So that's not who we loan to. Now, to be an investor in trust deeds, there's something called suitability. How do you define suitability? Capable of understanding what you're doing. Let's say we've had this happen sometimes. Somebody's dad dies, and they get $3 million for the first time in their life. And we get referred to them, and they come in, and they say, well, I've heard it's really good to invest in trust deeds. Is that a suitable investor for a trust deed? No. They got $3 million, but they don't even know what a trust deed is. We say no to that person because it's not fair to them. They wouldn't understand. It's very difficult to explain to them the whole process. And so that would take some time. That's not suitable. Okay. What also isn't suitable, if you will, is having somebody with $100,000 liquidity to their name and having them put that into a $100,000 trust deed. So the rules are that you can't invest more than 10% of your net worth after subtracting the value of your home in any one trust deed. So there's a form you have to fill out, and it's basically protecting people against themselves. Now, what's interesting about that is at the same time this came about, there's something called crowdfunding. Now, crowdfunding, how many of you guys have heard of crowdfunding? How many of you read the document for crowdfunding word for word? Okay. I have. Here's what it says. By the way, so it's a little bit different. When you get a trust deed at the Norris Group, you have a trust deed. You have 100% interest in that trust deed, and it's a first trust deed. On the document that I read for one of the largest funders of that type of project, a lot of times it's a trust deed for a house, for a fixer-upper house. The investment is you're getting the cash flow from the trust deed. So if you read the document, you don't own the trust deed at all. You're actually making an unsecured loan to the company. That's what you've done. So what would happen if you didn't get paid? You have no asset. You can't foreclose on something you don't own. The company owns the trust deed. And in the document, it actually said this. It said, most of all of our effort is going to go to create the next trust deed, so we may not have manpower enough to foreclose on the asset. That's pretty scary. So I'm sorry you didn't get paid, but oh well. Maybe you'd like another one. Anyway, don't do stuff that you're not familiar with, okay? So anyway, there's a questionnaire that you have to fill out, and you just don't want to be in trust deeds. When I invest in a trust deed, I have to sign the same thing every time. Is this trust deed 10%, more than 10% of your net worth? And basically, are you experienced at trust deeds, or a beginner, or in the middle? There's boxes that get checked, and this is the way the industry is. Unfortunately, it's taken a lot of suitable people out of trust deed investing. So if somebody has a 750 net worth and has 20 years of trust deed experience with us, all of a sudden we can't invest a dime of their money because they're suitable, but they don't meet the other requirement. So what it's done is it's steered money away from trust deeds to other things, probably that are less suitable and they're less knowledgeable on. Making a decision on how to do the investment in trust deeds. So why would you work with a broker? First of all, there's paperwork that's constantly evolving, and I think the software that we have to keep up with that paperwork originally cost something like $30,000 or more. So that's something you probably wouldn't do on your own. We have a ongoing effort to attract people to call us. So I speak in front of audiences all year long. The Norris Group is a household name.
So we get calls that there's no way a private investor would ever get. And then we filter through all the people that we say no to. What happens to private people that try to loan their money directly is invariably they break rules that put them at risk, and they don't know it. So it's very inadvisable to invest money in trust deeds without going through a broker. The broker doesn't cost you. It allows you to make a higher yield, and it also gives you deals that you would never see on your own. Yeah, Craig acts like a detective every day. I hear him with his underwriter on constantly. It's almost like you have to really win him over to get a trust deed. Rick Solis is our appraiser, and one of the biggest compliments ever, he said that he's done over 10,000 appraisals in his life. We're the only company that has never tried to steer him to a value, ever. We just want to know what it's worth. That's it. And whatever it is, okay? That's an important piece, is that we're really trying to do what's the best for the investor on both sides. We want to have safe trust deeds. Why the Norris Group in particular? One thing that we're very good at is we're very good at looking at what's next in the real estate economy. And we produce reports every couple of years that are 200 pages thick, and we have usually 450 people attend those events. We have to know when to make decisions to be conservative, and that's part of what that research does. The group that we have at the Norris Group has a lot of experience with hard money. Before I ever got involved in hard money as far as a business owner, I borrowed hard money from Craig Hill at another company. With him and Robin and Rhonda, we have over 100 years of experience. And there's some decisions, I put it this way to somebody. I said, I can answer every question exactly the way Craig Hill does, because I've heard him for 20 years. The difference is he knows why that's the answer. So he had about 15 years of experience before coming to the Norris Group about trust deeds. And there's times that he makes decisions that on the surface you would go, well, why wouldn't you do that loan? And then all of a sudden something comes to light about the transaction. It's sort of like, have you ever had that person in your life where the hair goes up on your neck and you don't know why, but you stay away from that? He has one of those abilities where, maybe there was, and sure enough, he's usually dead on. So we rely sometimes on that type of thing. Integrity, what's nice about the internet is you can check people out. So it's completely worthless for me to tell you how honest we are. So you check out the Norris Group on your own, and I think you'll find the experience, it'll be positive. One thing that happens, sometimes payments aren't made. We have relationships with everybody connected to solving that issue. We're in the repair business. There's nothing I haven't done to a house. I've lifted them off of the foundation and done all the stuff you see on TV from the shows. I've done all that. So if you ever have a problem with a trust deed, we wouldn't disappear. We would be involved and say, what do you want us to do? You want us to help you get to the finish line, we will assist you in doing that. Again, only first trust deeds, no pooling, and to me that's just a really big important piece of what you need to understand is how many of you are invest in trust deeds right now? I'm just curious. So really very few of you. When I found this niche, I got really excited because for me it was a diversity. I had bought and sold properties a lot, and then I started having rentals. And when I started having rentals, not everybody came through with what they said. And that was interesting, because I always make my payments, and I was a little bit ignorant of the fact that there's people that don't do that. And then they wreck your properties and stuff like that. And so it was really nice to have some of my money and what I call automatic pilot. I remember being on a cruise one time, and the stock market was doing its thing, going down 500 points a day or going up 200 and down 500. And on the cruise, you eat dinner together, and everyone else was just biting their nails on what they had in investment world. And I remember thinking that when I get back, all there's going to be is a little pile of checks that I'm going to get from the trustee investments because they were carefully selected, lent to the right people. One of the things that we don't have on this presentation, want to just discuss for a minute the product type. One of the things that happens in pools is that the product type expands sometimes. Let's say you raise $10 million, and people that have the money in that pool are expecting some kind of a yield. What do you think the odds of that money sitting there all year and somebody just handing it back and saying, I'm sorry, we couldn't find anything to lend on? That's not likely. So maybe they go, let's try to do loans to homes, but sometimes you have what I call product creep. So all of a sudden you're not doing enough loans to homes that are going to be rented or fixed. All of a sudden you go to, well, let's try commercial, or let's do land. Okay. When you do pools, you don't have really a discussion about that. If you wanted to be part of that, it just sort of gets creeped in there because that's who wants to borrow the money, and it creates a yield until it doesn't. So you have to be really careful with product type, because at least with a single family, you can go stand in front of it and say, if I take that back, this is what I own, I can deal with it as a rental. When you get involved in something that you got 40 acres of land somewhere, that doesn't work out so good. And a lot of the pools that went very heavy in 2004 and 5 and 6, they couldn't loan their money to single families. They started doing projects and started doing land developments. And when land goes down, it doesn't go down by a little. It gets crushed. So that's one of the things you have to be careful of, is that when you're doing something, stay within a product type that you understand. When we get called up for commercial property, the answer is we don't do commercial loans. And why? We don't have a commercial expertise. We really don't. And so, yeah, we could maybe make more big loans, but to be honest with you, I'm not an expert enough to protect ourselves in that case. And that's what I'm uncomfortable with. So we stay in a pretty tight range. Almost all of our trustees are 1 to 4 units, which falls into the residential rules. And so whatever you do, make sure that that's what you stay with. If you're going to put your hard money to work in a trust deed, make sure that you understand the product type that you're getting involved in. Make sure the person's making a monthly payment. Make sure they have skin in the game. Make sure they have experience that's equal to the project they're taking on. We get that phone call all the time. It's here's a really good deal. Then you find out that it's hanging off a cliff in Newport Beach, and it needs caisson work or something. You go, have you ever done that? No, but I hear it's easy. That's how people get burned. Really encourage you to not do it yourself. What happens is sometimes, like I said, we say no to a lot of borrowers. Sometimes you'll have a trustee investment and we pay you back and say we're working hard on getting the next good loan for you, and maybe a month or two go by, we'll get a phone call, say you don't have to worry about that, I've already placed my money. Okay, well tell me what you did. And within the first 2 sentences I said, okay, well you just broke the rules. And by breaking the rules, it means that you could get sued and you have an unsecured asset. That's what you've just risked by getting yield. Okay? It happens almost 100% of the time. I've actually never had a phone call from a private investor do it right, ever. Because it's not that easy. And it's so easy to chase yield. That's another thing. In this market right now, we've decided to be safe rather than risky. We're doing 6.9% trust deeds, and we have people with a lot of money taking that trust deed because it's a no-brainer safety. And sometimes safe is better. I don't know. You probably feel like I do. It's taken a long time to gain the assets that I have. And my highest priority right now is to protect the principal of those assets rather than aggressively go after gains. We see different types of people come through our doors for trust deed investments. And it's very interesting to see that there's some people with fabulous net worth still very attracted to something that pays them 14% interest, that rolls the dice, that could risk their principal. That's just not me. Yes, sir. Yeah, we would direct traffic. Basically, we don't foreclose on the properties ourselves, but we have a company that does that. Okay? The expense is borne by the investor and the trust deed. If you get through the whole process, which again is doubtful, we would have, if you wanted us to direct, okay, you need it painted, you need it so forth, we would have contractors to deal with that. In 20 years of business, that's happened less than 5 times. So it's not a common occurrence, but it's a good question to ask. Absolutely. We're going to have a Q&A session after we're all done speaking, and so maybe I'll just have you save the questions for then.